Okay, welcome everyone. We're doing our quarterly investor update for Q2. We're going to be talking about Grove Parkview. So our theme this quarter was really building on a stronger year, and we are 15 months in. We're really excited, 15 months under management, and we're excited to see kind of how it's going. The biggest thing is that we won Best Apartment Complex in Mountain Park for 2026, which was very, very important. So we're excited that Grove Parkview won it, which we just like adds to the reason why we bought it and how we're managing it, and also speaks to the most important thing, which is our staff on site. So welcome today to everyone who's joining in online. So kind of the biggest thing I wanted to talk about is 15 months in, we're ahead of the plan. So kind of where are we, right? If you remember, Grove Parkview is 268 units. We bought it last last March. We bought it last March. And so we're 15 months in. Q2 of this year, we had an NOI of about 623,000. And we underwrote that at this point we should have had a net operating income of about 703,000. So we are 11% under budget. But that is kind of like definitely an improvement from Q1, because Q1 we were at like -14. So we're moving up in the right direction. Occupancy, we're happy with where occupancy is. We can bring it to above 95, but at Q2 it stayed at 94%, which was really, really great. We cleaned up delinquency. It was up in April and we brought that back down. And then operations have been steadily improving month after month. So Q2, everyone should have received their Q2 distributions. And so super excited about that. And so our goal is like, how can we kind of close the gap on what we're building? Okay, so then the next thing I want to talk about is, again, right, it's the biggest challenge we have, which we're working on, is it's narrowing that NOI gap, right? So what are we doing right now? So NOI is kind of like the cleanest signal on whether like the plan is working. So I told you Q1 we were at -14%. We're down to -11%. And so we're closing that gap, and we're doing that by delinquency, really cleaning up delinquency and increasing occupancy. So we're at 94%, and the goal is 95, but that operational expense kind of remains at 6% above our underwriting, which is very, very important. So May and June improved significantly, and that is kind of where we are. So we want to lift, we want to hold, and we want to refresh what we're already doing. And then so the kind of thinking through Q2, right? This is just a snapshot on what month by month looked like from the actual financials versus what we underwrote. So it's important for you to see April, May, and June, where we are with how much we brought into the property. So for instance, our actual gross potential rent came in at about 405,000, and we actually underwrote for about 447,000. So we're just a little shy of that, but kind of looking at it month by month, looking at what is working, what isn't working, what do we need to fix. And so the biggest thing was bad debt, right? So in April, bad debt spiked. But if you notice, May and June, it continued to come down, which is what we want. So we had that spike, and then it was before we cleaned it up. And then May and June was significantly better. And we actually did better than our underwriting. So that's just kind of giving you a snapshot of where we are, our operational expenses, what our net operating income was, where it was, where it should be, and what we're doing to close that gap. And so we have had over 12 months of operation. And so I just wanted to give you a snapshot of what 12 months looks like. So we have averaged a net operating income of about 202,000 on a monthly basis. And so that has been anywhere from 162, which was our lowest, to 256, which was our highest. But the asset is performing at plan. We're going to have months that maybe we dip a little bit because of delinquency, because of bad debt, some because of operational expenses going up. But for the most part, we want to see it kind of stay steady at our underwriting. So this is just kind of letting you know, this is where we are, this is what we're doing, this is what we're building. So our approach truly is really thinking through like disciplined, kind of disciplined operations. And then again, the goal is narrowing that underwriting. We want to do better than what we underwrote when we said we were going to buy the deal. So again, right, we are at 94% occupancy, which is great. We want to be at 95. So we're pushing to figure out what we need to do to get that extra percent. Our T12, the net operating income is at yearly is at about 2.4 million, which is about 202,000 on monthly average, right? But the way the property is operated is truly like our primary signal. So we really are looking at occupancy, we're looking at the NOI, we're looking at operational expenses, right? Those are the key factors to know really how we're doing, and also thinking about how we're going to close the gap. So operational expense ratio, we're at 47%, which is good. We want to, for a 1989 property, right? We want to be around that 45 to 50%. So we're exactly there. So the things that we really need to do are to really build up, our occupancy, really trying to decrease our expenses where we can, manage the property efficiently and not run it too thin. And so when we're looking at kind of like the economics, right, this is just a snapshot of what we bought the property for. We bought it at 49.1 million with a going in cap rate of 5%. We're looking now, we're 15 months in, we're not yet at the time that we're starting to get broker opinion of value to think about selling, but we're at the time, we're going to hit the 2-year mark soon. And then shortly after that, we're going to start thinking, okay, is this the right time to sell, right? Where are we in terms of like closing that gap? Where are we with occupancy, with delinquency, with bad debt, with operations? How are we managing it? What is our net operating income? What's coming in and what's our cash flow? So those are the things that we're thinking about right now as we're operating it. But our goal is, how are we doing as the property? How are we managing it? How are we growing? How are we growing rents? How are we decreasing expenses? And so again, as I talked a little bit about thinking about positioning for exit, right? So again, we are thinking about selling 2029, 2030. We have some time, right? We're not racing to it. Our goal right now, like I said, is to manage the asset well, make sure that it's performing on plan. And then we're kind of tracking that goal of the 5-year, our 5-year underwritten hold, our plan to sell in 5 years. So from an operations standpoint, right? Again, we're keeping it, we're at 94% occupancy. We're happy with that. We can push a little bit more. I talked to you a little bit about the delinquency that happened, the spike in April, but we've cleaned that up. And just like really being disciplined across insurance, making sure that when we're looking at our expenses, I told you, how can we keep that operational expense at less than, we want to keep it closer to 45%, but that really looks at our property taxes, payroll, insurance, right? The things that are heavy hitters from an expense standpoint. What are we doing to decrease that, if at all anything? And then from a value add standpoint, right, we're figuring out where are the things that we're putting resources and efforts into. We're going to start renovations pretty soon, but right now the things that we've already done, right, the sports court lighting is complete, the dog park is completely complete, we fixed that, the pool renovation is complete as well ahead of summer. So these are all the capital expenditures and all the value add that we've added to the program. And we're also going to do the sports court, the resurfacing. So we have bids in right now, and then we're just kind of figuring out who we're going to go with. So that's part of the exterior value add as we now start planning and working on interior renovations. And I told you again, right, we're targeting 2029, 2030 sale, and that would be a 5-year window. So we're just kind of watching right now. As we manage the property well, we're also watching to see what is going on in the Atlanta market, right? So making sure that like we're still, and that's one of the things before we even bought it, right? We looked 5, 7 years down, like, would there still be buyer appetite to buy? And we feel very comfortable with that. And so kind of where the things that we're looking to mitigate the risks, right? I want to name them just so that you're aware of them. So where will cap rate be, right? Like, where will that be when we're ready to sell? That's something that we're always keeping an eye. will it compress? Will it expand? We're thinking about that. And then like the operating expense pressure. So we're looking at, again, I told you, insurance, payroll, property taxes. We're watching that closely because those are big drivers in expenses. And we want to try to keep that ratio, the expense, operational expense ratio around that 45%. And then we're also looking at the market, right? What is it doing? Is it softening, right? We're looking at the demand, the Stone Mountain demand, and we're making sure that it remains durable throughout our hold period, making sure that we're staying at 94 to 95% occupancy. And we're also tracking how rents are growing in the area because that's really important. Our delinquency, bad debt, we're kind of watching that very closely, making sure that like if there's a spike, we quickly clean that back up and making sure that we're comparing it to where our underwriting is, because that's the most important thing. And then value add, right? Making sure that like where are we, what are we supposed to be doing in terms of our value add? So we're a little behind on our interior renovations, but we're starting that back up. But we focus on the exterior and we're done with all of that. So those are some of the, as we think about what the next year and a half, 2 years looks like, these are the things that we really want to keep in mind to make sure that we're operating well. And so what does the next, like, what are we looking at for Q3? Because we're going to meet again next quarter, but really our goal is to, again, push occupancy. We want to keep it at 95 or above, right? If we're at 96, 97, it's going to be a really sweet spot for us, but we want to complete all the capital items that we said we're going to do and really start making sure that like the CapEx is funded from cash flow. So money that's coming in is very important, right? That we're using that to complete our renovation. So we're not dipping into equity, which is very important. And then everybody should have gotten their distributions last month. So we want to keep at that. We want to continue to distribute, and then we want to close the gap because we want to get to that 6% preferred return target. But remember, right, whatever we don't give you, we just move it. We still owe that money to you. So it's not gone. You're just going to get it on the back end. And then we're just going to see what the market is doing the next few years just to make sure that we are on task. But that's really the goal of like our property management team, the asset management team, are what Phoenix, like what we owe you guys, right? The next quarter, this is what it's going to look like. This is what we're pushing towards so that you know that like this is where we're going, right? We really want to make sure that we're stewarding the asset, against the underwriting. So we were at 14%, now we're at 11, and we hope to continue to go down as we manage the property better. And so this is kind of like, as we wrap up, this is what 15 months in looks like, right? We're ahead of the plan. We're kind of ahead of plan, which is really good, right? We want to focus heavily from an operational standpoint. We want to make sure that that capital is aligned. So you're getting your preferred return and that 80-20 split, right? That's where we plan to be and continue to meet that. And then with the goal to exit, 2029, 2030. So we still have some time. So our goal is to, managing excellently from an operational standpoint, making sure that we're where we need to be and making sure that we're watching the Atlanta market just to make sure the conditions are favorable when we start thinking about selling. So that's what Q2 looked like. And I'm excited to share this information with you. And then I will see you next quarter as we go through Q3 with our plan to keep us accountable on the things that we said we're going to do. So have a wonderful evening. And I will see you next month.